Joining us now to discuss the crypto markets, we've got Wave Financial co-founder and CEO, David Siemer. David, we just talked about the U.S. jobs report coming up, 517,000 jobs in January, topping analyst expectations of 187,000. The unemployment rate now is at its lowest in 53 years at 3.4%. Your reaction and what this means to the markets?
Yeah, that was an absolute shock. I don't think, there were a few people that had expected a upward surprise, but nobody came close on guessing these kind of numbers. And I think the thing what it means is a lot of people just got too involved in the narrative of what's going on in the markets. Inflation is up, interest rates are way up. That usually leads to jobs going down. So I think everyone was kind of ignoring a lot of kind of minor economic data and thinking, okay, well, we've got to see this huge jobs reversal at some point. It should be now. And I think a lot of companies got kind of caught a little bit. Speaking for Wave, our own company, we were pretty slow in hiring into the year, and then in January we actually added a few people also, just like, okay, we really need some people, and the world doesn't, and we're really busy. So, and I think a lot of companies kind of felt that way, that there was kind of this self-fulfilling prophecy that the world was going to go into recession, and maybe it's a soft landing, maybe it's a hard landing, and I think there is still a recession coming. But there is a lot more strength in the jobs market. There's a lot more strength in consumer spending than I think anyone was trying to pay attention to.
How does that fit into the Fed's announcement this week that the disinflationary process has started?
I don't think it helps out a whole lot. The last Fed meeting just a couple of days ago, I think everyone was mildly surprised, or in some cases people very surprised. They were relatively dovish, that they were kind of expecting a harder line. Obviously, they cut it to 25-point raise. I think they've the Fed and Jerome Powell have kind of hamstrung themselves now a little bit. I don't think it's easy to revert back to 50-point increases, which I think probably would have been what they would have done had they seen this jobs report. But they're so I think we are going to see them just continue to raise at 25 basis points for a pretty long time. And what Jerome has been saying forever is accurate. That the Fed's job is not done. They have not tamed inflation. They have not. The jobs market is overheated. The stock markets seem a little frothy. So I think there's going to certainly be no changing of course now.
Meanwhile, the markets are pretty positive. Bitcoin is up over 40% this year. The ARK Innovation ETF, which is in 2022, lost about 2/3 of its value, gaining over 40%. Meme tokens, also tracked by Roundhill Meme ETF, soaring almost 40%. What can you say about this very bullish sentiment out there, and putting risk assets back in the spotlight?
Yeah, I think especially with this jobs report, the narrative of a soft landing, and yes, I know we've never actually achieved a soft landing in history, but the fear of a soon hard landing seems to have dissipated a lot. And I think the reason, all risk assets are up. The reason crypto assets are up so much is because they were so oversold. The traditional markets didn't have an FTX. So I think a lot of this is just kind of the natural reversion to mean that things were heavily oversold. But I think we're going to continue to see after this jobs number, we'll see it today, everything's going to be down because it's kind of a shock. But I think we're going to continue to see relatively good strength along all risk assets.
Yeah, here we have a chart on long-term sentiment in the markets. Near the end of January, the retail market orders as a percent of market value reached 23%, according to JP Morgan data. What can you say about retail investors coming back?
Yeah, I think everyone kind of fell into the same narrative as I said before. That, inflation's up, rates are up. That means the end of fun times for everybody, and things are going to head down pretty quickly. And that just hasn't been the case. The consumers are really resilient. Yes, housing prices are starting to head down. But the rest of the economy really isn't cooling off. And people at the local levels, most people aren't experiencing the beginnings of a recession. I think is what we're seeing that in consumer spending. Consumers are usually pretty nimble when they do start to see a lot of layoffs around all their friends. They stop spending as much, and it just isn't happening. So I think most, I think when you ask, manufacturer indices and, those people who procrastinate the future, they're just doing what they've always seen. Rates are high. We've got to see a slowdown coming. But consumers really haven't gotten that message, and they're continuing to spend, and they're continuing to take vacations and do all the things that keep the economy humming.
So, David, what would you say about this rally we're seeing? Is it sustainable, or is it just a bear market rally?
I do think the recession's coming. I'm a little more optimistic after today that it won't be quite as severe a recession as an '08 recession or a major recession. But I do think we're overdue. Yes, consumers have been pretty resilient. That's always kind of the case until it isn't. I think the fact that the Fed's actions are having such a slow effect doesn't mean cumulatively they won't eventually have a major effect. And I think it's just going to take a little longer than the Fed would like. I think we're probably still a quarter or two away from seeing what the Fed's actions have really actually done to the economy.
All right, David, thank you so much for your analysis. That was Wave Financial co-founder and CEO, David Siemer.